Afternoon, everybody. I'm just going to wait another 2 minutes for some more people to join us. So the broadcast will commence in 2 minutes' time. Many thanks. Good afternoon, everybody. Thank you very much for joining me today. My name is Mitch Young. I'm a qualified tax advisor, co-founder of Fusion Consulting and head of the taxation division. We are Life Residential's recommended tax partners, and we assist all our landlords with tax compliance and advisory. Now, it's a great time to have this webinar today because we are just on the cusp of the new tax year, which is going to be over the next couple of days. So it's a good time to find out and share all the latest tax changes and some other planning points of what you should be aware of. Throughout the webinar, I'm sure that you will have questions. So feel free to pop them in the questions box below and I'll get to them towards the end of the webinar. Alternatively, you will find my email address throughout the majority of slides, and what we are offering for all attendees today is a free 15-minute consultation with myself where we can discuss your UK tax affairs in greater detail. We've got quite a lot to cover today, but my aim will be to finish in around 30 to 40 minutes. So hopefully we'll get through in good time. So here's today's agenda. I'm just going to talk you through this, and then you can see on the left-hand side, if you'd like to get in touch with me, you can send me an email, mitch@fusionconsult.co.uk, and then we can arrange a free 15-minute consultation. So the first things we're going to look at is the changes to the allowances ahead of the 2019-20 tax year in the UK. We're also going to look at who is actually entitled to a UK personal allowance. This is something I get asked about on numerous occasions, so we're going to go through that in a bit more detail. We're going to look at significant changes over the past couple of years to the UK property market and taxation, in particular the reduction of mortgage interest against your rental accounts. Also, specifically of how a non-UK resident individual has now been brought into UK tax and the levels of compliance in which they need to adhere to. So we're going to look at that in a lot more detail. We're also going to look at property structure, how best to hold a UK property, given all the recent changes in the UK. There is a significant amount of tax planning opportunities, and we're going to go through them in a bit more detail further on. We're going to look at a landlord's responsibilities, a little known disclosure amnesty, which I'll go through, and then a bit about my company. So there's a lot to get through, and feel free to get in touch as we progress. Okay, so on the screen now we have the 2019-20 tax rates and allowances, and you'll be pleased to know if you are entitled to allowances, these have increased. So if we look at the personal allowance along the top, you will see that that has increased from £11,850 to £12,500. The tax years in the UK runs from April to April. So as of the 6th of April, an individual can earn £12,500 in the UK without being subject to tax. When it comes to rental property, you are taxed on the profits. So if you just have one rental property and the profits are within £12,000, then there be no tax. And profits are the rental income less allowable expenses. And I'll come on to what is considered an allowable expense further on in the webinar. So that's good news. The next line goes through the capital gains tax annual exemption. So this is when you sell an asset in the UK, most likely UK property, then if you make a profit, i.e. a gain, then the first £12,000 of that gain is exempt from capital gains tax. And then I've just listed the income tax bands along the bottom there. So you can see that on the first £50,000 above the personal allowance, one will be subject to income tax at 20%, and then from 50,001 to 150,000 is at 40%, with the additional rate in the UK at 45% over and above income of 150,000. Just a point to note, really, that even if you have rental profits which are below the personal allowance, or indeed the capital gain, then you still have a statutory responsibility to submit your annual tax returns. Okay, so moving on to who is actually entitled to a UK personal allowance. So an individual who is a national of an EEA state, i.e. UK, France, Germany, Italy, Spain, is entitled to a personal allowance. All British citizens, so that's anyone who has a UK passport is entitled to a personal allowance. There are various countries across the world who has agreed what's called a double taxation treaty with the UK. These are countries such as Malaysia, India, Israel, and these individuals will be entitled to a UK personal allowance as well, even though they're not UK resident or living in the UK. Commonwealth citizens are entitled to a personal allowance, so Australia and the like. And any country where there is no double taxation treaty currently in place with the UK, there will be no entitlement to a UK personal allowance. So that may be an individual who has never lived in the UK and is now, let's say, living in Singapore, has always lived in Singapore but has bought UK property. They will be subject to tax on the profits, whether that will be £100, £10,000. They will not have a personal tax-free allowance. And this is where you may see, some of you may be aware of the non-resident landlord forms. When you first set up and started to rent a property, you can have the choice to whether to pay tax at source. So for instance, Life Residential will deduct the tax from your rent and pay it over to HMRC, or indeed get the rent paid gross. So that's who is entitled to a personal allowance. So hopefully that's clear. Okay, so one massive change that has affected UK landlords is the reduction in mortgage interest. Now, this first came in April 2017 and is being phased since then over the next 4 fiscal tax years. And what this means is essentially HMRC and the government have said you can no longer have the capability to deduct the full amount of your mortgage interest against the rental income when computing the profits on your annual basis for tax purposes. Now, this is only for individuals, okay? It doesn't apply to corporations, UK limited companies, overseas limited companies. It only affects where you have an individual landlord who owns a UK property and has a mortgage in that individual's name or joint names. The way that it works is that you now, when computing your profits, instead of having your rental income, let's say it's £10,000, and you deduct some management expenses, if your mortgage is £10,000 for the year, you cannot include that in your tax calculation. So then what happens is that the £10,000 becomes taxable, and then from that amount, you can only deduct 20% of whatever the mortgage figure is. So appreciate that that's quite confusing to go by, and here's a table of how it's being phased in. So you can see last year you were allowed to deduct 50% of the total mortgage interest against your rental income, and the other 50% you could only restrict to 20% of that. This current tax year, so the 2019-20 tax year, you can only claim and deduct 25% of whatever the total mortgage interest figure was, and then the remaining 75% you can only deduct the 20%, and then finally in the year after, 2021, then you can only deduct the 20% of whatever the mortgage interest figure comes in. This has led to, we'll come on to property tax structuring, a number of landlords who have multiple properties which are highly geared, highly leveraged with mortgage interest, to say, well, if I can't deduct that, I'm going to be subject to tax on artificial profits. So how best now can I structure my property portfolio? Now, some have sold their properties because it doesn't make sense from a tax point of view. Some have looked to move their properties into a limited company because, as I mentioned, when you have a limited company, you have a corporate mortgage, then you're allowed to deduct 100% of the mortgage interest figure in the limited company accounts. So a lot of landlords have looked down that route, but there's a number of factors that you need to consider when it comes into that. It's not just one tax you need to look at, it's a number of different taxes. And I'll come on to that when we talk about the property tax structuring. If anyone has any queries on that or wants me to provide an illustration, I can happily do that as well when we discuss your personal matters in more detail. Okay, so moving on to some other general tax changes, which one should be aware about. So the rental room relief, again, this is a little known tax relief. It's only available to a landlord or I guess an individual who is renting a room in their main flat or house. If they are doing this and they're receiving monies for renting a room in their flat or house, then they can claim this rent and room relief, which is essentially the first £7,500 of that income is not subject to tax. So a few people don't know about this. Landlords previously got used to this concept called wear and tear allowance. And this was for any landlord who owned a furnished property. They could deduct 10% of the gross rents as a deduction in the calculations. This relief had been around for a number of years, and last year HMRC withdrew this amount, and instead what they said was that a landlord can claim the cost of replacing of furniture, beds, couches, sofas, whereas before the wear and tear was essentially given to as a token amount to justify the replacement of things like the beds and the sofas. But now you can actually claim the cost of these items against your rental income on an annual basis. The ATED. So ATED stands for Annual Tax on Enveloped Dwellings. And what this means is that where you have a residential property that is owned within a limited company and is valued above £500,000, the landlord needs to submit an additional tax return and potentially pay an additional tax. So the government brought this in to stop foreign nationals from purchasing through offshore entities residential property for their family members to live in. So essentially now, every April, if you have a property, residential property owned within a limited company, you need to complete an ATED tax return by the 30th of April every year, or face strict penalties. If the property is rented out commercially, so it's rented to a third party and not to a connected person, then there are reliefs available so that this tax charge won't apply. But equally, you will still need to complete this annual tax return, the ATED tax return, on an annual basis. So to give you an example, on a property between £500,000 and £1 million, the annual tax charge for this is £3,650. and tax returns have to be filed by the 30th of April 2019. So obviously, if that applies to you, you've still got around about 3 weeks to submit the ATED. And if you weren't aware of that, then we can help you bring your tax affairs up to date. Most people actually do rent to a third party on a commercial basis, so there often is no tax to pay, but equally the tax return still needs to be prepared, and the penalty regime can be quite high. So please bear that in mind. And then finally, we have stamp duty. So as I'm sure a lot of you are aware, there was a stamp duty increase and surcharge which has come in. Now, it's an additional 3% on top of the standard stamp duty rates. So the stamp duty rates are now tiered. So for example, between 125,000 to 250,000, it's at 2%. Between 250 and 925,000, it's at 5%. 925,000 to 1.5 million, it's at 10%. And then over and above 1.5 million, it's at 12%. And essentially, it's an effective rate on the property value. If you own another property, so let's say you've got your main property and you're living in China and that's your main home, and you purchase a UK property, so you will now have 2 properties, then you will be subject to the additional 3% stamp duty charge. So on all the rates I just said, the 2, 5, 10, 12%, if you own another property, then you'll be 3% on top of those rates. Key thing is that it doesn't matter where you are in the world. If you own one property and then you purchase a buy-to-let in the UK or another property anywhere in the UK, you'll be subject to that additional 3%. Some further bad news on stamp duty for a non-UK resident is that the government are currently consulting on an additional 1% for it's called the non-UK resident surcharge. So they're potentially going to introduce another 1% for any non-UK resident who is purchasing UK property. Apparently there'll be a response on the 6th of May on this. So if you are thinking about purchasing a UK property and you are a non-UK resident and you're listening to this, then I would advise to look to make the purchase between now and the 6th of May. It may not get approved, but usually when there's a consultation that's gone through HMRC, then the likelihood of that coming into play over the next year is quite high. Okay, so just a reminder to everyone, if you want to arrange a free 15-minute consultation, please feel free to get in touch, and you can, my email is along the bottom, and then you can just email me and book in a free 15-minute consultation. There's no problem at all. So we have a question here. So questions come through. Does the additional stamp duty apply for existing non-resident landlords? So the question will be that if you own a property and you now purchase another property, then you'll be subject to the additional stamp duty on the purchase of the new property. The stamp duty tax is a tax when you purchase a property. So if you were to purchase another property, then you'll be subject to additional stamp duty tax on the purchase amount. So thank you very much for that question. Okay, so non-residents capital gains tax. So this was introduced as of the 6th of April 2015 Prior to that date, any non-UK resident who had sold UK property wasn't concerned about their capital gains tax treatment in the UK. Now, if any non-UK resident sells a property, there are strict rules in terms of what they have to do. The first is they have to submit an additional tax return within 30 days from the sale. So this is similar to a self-assessment, but it's a smaller 6-page document called non-resident capital gains tax return form, and then that needs to be submitted within 30 days of the sale. Failure to submit that within 30 days of the sale will result in a penalty, automatic penalty of £100. Now, in order to calculate what an individual is subject to tax on the sale is typically capital gains tax. So how that's worked out typically in the UK is you have your sale price, so what you sold the property for, less the purchase price and associated costs, and if there's a gain, you'll be subject to tax at 18 or 28%, over and above the £12,000 capital gains tax exemption that we mentioned. However, what HMRC have said is that it's unfair to a non-resident individual to follow that exact method. So the non-UK resident individual can elect to have the market value price as of April 2015 as their cost price. So let's say you're a non-UK resident individual and you bought a property in Canary Wharf in 2001 for £300,000. You sold it for £1 million today. So typically there would be a gain of £700,000 in which you'll be subject to UK tax. If the April 2015 valuation was £900,000, what HMRC have said is that you will have to elect for this method of tax treatment on your capital gains tax return form, and you'll only be subject to tax on the difference between the April 15 valuation, which is 900,000, and what you sold it for, which was £1 million. So you'll only be subject to capital gains tax in the UK on £100,000. So it's quite important to get that right. Even in terms of you have to form an election as part of the capital gains tax return form. So that's an important thing. The other point to note, and a recent tax change, is that this will now affect a disposal of commercial property. So this is only brought in this year. So non-UK residents who are disposing of commercial property, this will also affect them as well, and they need to follow that. We've just got another question, which I'm just going to go to in a moment. So just bear with me. Did you say a tax return must be submitted even if you qualify for the personal allowance and below the allowance amount? Yes. So typically, one has a statutory responsibility to submit an annual tax return on rental income and profits, which are over and above £2,000 a year. So if you're receiving rental income over and above £2,000 a year, then you have a statutory responsibility to submit an annual tax return. This is something, again, I'll come on to a bit later on when it comes for disclosure work. So So even though there won't be any tax to pay, because you may be earning £10,000 and the personal allowance is £12,000, HMRC, the UK government, they want to know what rental income and expenses are going on within your property portfolio. So thank you very much. Okay, just a very quick slide on the principal private residence relief. So this is a tax relief which is available when you sell the property. If at any point it has been your main residence, then you can qualify for substantial relief. So it's worth noting that even if you've lived there for a month or 6 months or a year, then you would need to calculate the principal private residence relief, and then and that will lead to a significant amount of tax relief being deducted. So there's other things to look at here, such as periods of deemed occupation. So that may be if you've had to leave your UK main residence because of the purpose of going overseas, because of employment, then you may be able to qualify for what's called deemed occupation. So HMRC will say, well, you've had to go overseas, so we're going to give you that period, so maybe 4 years worth of gain as exempt. And furthermore, if you have let your main residence at any point, then you'll qualify for lettings relief. So lettings relief is essentially, it will be the lower of the gain, which qualifies for private residence relief, and £40,000. So if you have sold a property, you are thinking of selling the property, and at any point it does qualify for main residence, then the principal private residence relief is the main capital gains tax relief that is available to you. So I thought I'll just have a little slide on that. Okay, so I touched upon property tax structure and how best to now hold a UK rental property or property portfolio. Now, it's going to be impossible for me to deliver a one-stop shop scenario and provide everyone here with a generic point of reference of what they should be doing. What I will do, I'll try and cover a number of different points that have come up and what you should consider. Essentially, if you are an individual landlord and you only have 1 or 2 properties and they may be held in joint names, and you're entitled to the UK allowances, so that's the personal income tax allowance and the capital gains tax allowance, then typically it makes sense just to keep it in an individual or joint names. If you have a number of properties and you're building up a portfolio and that portfolio is going to be leveraged, then at that point, and leverage, I mean highly geared from a mortgage interest point of view, then at that point you'll need to look at whether a UK limited company would be the right structure. Now, why does a UK limited company become a good structure? One, because of the mortgage interest relief, you're allowed to claim the full amount of mortgage interest relief. It can give interesting scenarios depending on what you have within the limited company as well, in terms of debt and inheritance tax, which we'll come on to. We do a lot of planning whereby you have a landlord who has a number of properties and they say, how can I move it into a limited company? What are the implications of doing that? Well, essentially in the UK, a limited company is a separate entity. So what HMRC will say is that if you're an individual, you will gift the properties to your limited company. And at that transaction, there's usually capital gains tax to pay. And the capital gains tax to pay will be on what you originally purchased the properties for, less whatever the market value on the date of moving them to a limited company is. However, there is something called incorporation relief. So that is when you're incorporating a business. So you're essentially moving a business from a sole trader into a limited company, then you can roll over the capital gains tax. But you will need to show that you have a business. So things like you're working a number of hours on the maintenance of the properties, you won't have a management agent, etc. The other things to bear in mind if you are thinking about moving the properties from your individual or joint names to a limited company is if there is lending, then there could be a stamp duty tax charge. One way to potentially maneuver around that is if you have an official partnership, and that is where you have two owners and they're in partnership, and then in a couple of years' time you incorporate into a limited company. Potentially there could be some stamp duty relief if it's done on a commercial basis. The other things to bear in mind is if you have a limited company or some type of structure like that, then, you know, we mentioned the ATED, so that's when you have residential properties within a company above $500,000, so there'd be additional compliance. Owning within a corporate entity, there's additional company accounting that you need to look at. But also, you know, you could look at a corporate group. So you have a number of limited companies owned by a holding company, and there could be some good planning around that. So essentially, what you have to do now is, if you are thinking about a property tax structure, and what we do for our clients is we produce a high-level analytical report. So it will say, this is what you're currently doing. Here's option 1, 2, and 3. This is the interaction between all the different taxes: corporate tax, income tax, capital gains tax, stamp duty, inheritance tax, and this is our advice. And without having something like that and looking at the numbers black and white and how it's going to affect you short, medium, long term, it's impossible to make a decision, because in the UK, as you can allude to, is that property and tax, there's so many different taxes you need to consider. So you really need to be careful and get some tax advice when you are looking at property tax structuring. And the final point on this, before we move on briefly, is obviously UK residential property is now subject to inheritance tax. So an individual will have an inheritance tax allowance of £325,000 each. And then over and above that, they'd be subject to inheritance tax. So you have to look at your exposure to IHT, inheritance tax. It's at 40% on death, over and above the 325,000. So that, you know, you need to look at potentially some your debt arrangements or even sophisticated planning, like what's called a QNUPs. But that's something we can help you if that's something you desire. Okay, so we're just whiz through this section. So I'm sure you're all nice and compliant and know of your responsibilities. So as a non-UK resident landlord, or just a UK resident landlord, you need to be registering and filing a self-assessment tax return every year. And as mentioned, it doesn't matter if it's below the allowance or not. This needs to be done, or you could face penalties. So you need to get a unique tax reference number. It is difficult to, if you are overseas, to actually submit this electronically because HMRC do restrict a number of international softwares. So that's something we can help with. We mentioned the non-resident landlord. So as a non-UK resident landlord, you'd need to register as a non-UK resident landlord, let HMRC know that you are a non-UK resident, and then let your managing agent know whether you want to receive the rental income as gross or net of tax. But make sure you complete those forms. 31st of January every year is the submission deadline date. We mentioned when you sell a property now as a non-UK resident, you need to complete a capital gains tax return form within 30 days of the sale. And it's being announced that this will actually apply to UK residents as well moving forward. So it's not just non-UK residents. And some allowable expenses. So typically the way I tell my clients is that you should look at your rental property as a business. So anything that you're spending money on with the rental property should be deducted. However, one key point to note is that HMRC distinguish between what's called revenue expenditure and capital expenditure. So revenue expenditure is things like repairs, maintenance, management costs, the loan interest, your tax advisor's fees, travel to the property, things like that. The capital expenditure is any type of expenditure which is going to significantly increase the value of the property. So that may be a brand new kitchen, a brand new bathroom, an extension, a new roof. So those items of expenditure will be deemed as capital, and you won't be able to offset them in your annual income tax assessment. What you'll do is you keep a note, or your tax advisor keeps a note of those, and then you're allowed to offset that against the capital gain when you sell the property. Okay, so just bear that in mind. Right, so this is a lovely piece of legislation. Just thought I'll bring it to your attention. So this is a common reporting standard. So what it means is essentially a number of countries have agreed to sign up to this. And what it is that they've agreed, all the financial institutions across these countries have agreed to exchange information on their residents. So you may have a situation whereby, you may have a bank account in Singapore, and you own a UK residential property. So the HMRC will get information from Singapore and your residential property, and the two nations under the CRS will speak, and more information is getting gathered so that HMRC will have a lot of information at their disposal. So what's happened is that HMRC has spent £4 million on their systems. So they now get live feeds from these jurisdictions, but also from things like Google, a number of agents, lenders. I think there's 13 different points of which they get live data. So what this has led to a significant amount of what I call tax investigation letters. So we've received, or we're taking on new clients where they're getting letters saying that we're aware that you rent a UK property. Please can you confirm this is the case and why you have never disclosed this amount? And if you get a letter like that, then you will be subject to a number of penalties going back a number of years, and it'll be difficult to argue your case. An argument saying that you weren't aware of the responsibility or you didn't think you had to, it doesn't hold up. So it's really important to comply properly, and if you haven't, then please speak to me. We've had existing clients who have got letters now from HMRC saying, we're aware that you have overseas bank accounts. How come this was never disclosed on your tax return? So, please do your best to comply. And if you haven't complied, there is some good news. So there's a little known disclosure amnesty available to any landlord across the world who has never submitted a tax return to HMRC. It's called the Let Property campaign. What you can do is you can register with HMRC. Once you're registered, then you get a reference number, and HMRC cannot investigate into your tax affairs. Then you go about completing the legal disclosure pack and completing every outstanding tax return for whatever years. And then you have 90 days to submit that. And once submitted, if there's any tax to pay, you pay that. And then you get a certificate from HMRC to say that your tax affairs are fully up to date. Please comply moving forward. Now, the benefits of doing that is that, one, obviously there's no prosecution, no criminal prosecution, no further investigation. The second is that you get a reduced cap penalty of 10 or 20%. So if HMRC were to write to you, then the penalties could be as high now of 110%. Okay, 110% of the outstanding tax could now be as a penalty on top of what you had to pay. Under this disclosure, it will be 10 or maximum 20%. We've done this for hundreds of our clients. It gives them complete peace of mind. If you're in a situation where we had a question earlier, whereby you are under the personal allowance, but you've never completed a tax return, you could be subject to £1,200 worth of penalties for X number of years. Under this disclosure, one of the great things is that if there is no tax to pay, you can register and complete this disclosure, and there won't be any penalties to pay either. So that's a really good point. You know, if there is no tax to pay, you can register for the disclosure, get your tax affairs up to date, get no penalties, and everything is good. So as I mentioned, you know, we have a great relationship with the HMRC office in Liverpool that look after this area. We've helped hundreds of our clients with this. So if you would like to find out more information on this, then please send me an email. We can have a private and confidential discussion. My email address is along the bottom there, mitch@fusionconsult.co.uk. So we're coming to the end of the webinar. Just a brief slide about my company. So we are experts in property taxation. We act for over 100 landlords. We have an exclusive relationship with Life Residential, so that when you sign up as our client, Life Residential also provide us with your rental information so we can complete the tax returns in a very easy fashion. We do the tax structuring reports, tax disclosure, tax advice, inheritance tax planning, and we're offering a free 15-minute consultation to anyone here who would like that. Just send me an email. We act as your agents with HMRC, so they send a copy of all the correspondence on a yearly basis to our office as well. And anything you need, we'll be on hand to help with. We deal with all the compliance and all your advisory on a year-by-year basis to ensure that you're compliant and efficient. So there's my email and our website as well. And if you don't want to email and you just want me to arrange the call with you, feel free just to type a note in the note box or yes to arrange. That's no problem as well. And if there are no further questions, then I believe that's us finished. I thank you very much for your time and your attention. I hope you found it useful, and please feel free to get in touch, even if it's just for some feedback. Have a great afternoon and evening.